Okay, well, it's great to be here. And I think the last time I saw you was like in San Francisco 2 years ago.
It's been a while.
Yes, yes.
Welcome.
Uh, so we're going to talk about founders and product, and is people more important than product? And we've both been investing for a while. We often hear VCs say it's always about the team, it's always about the team, and you can take a kind of B idea, but with an A team, it'll go further than an A idea with a B team. So what's your take on this?
How about an A idea with an A team?
Well, yeah, we all want that.
No, I definitely over-index on people for sure. In fact, to a certain degree, I almost don't care about the idea in the beginning, right? What I'm really focused on is trying to kind of understand kind of the psychology of a founder and like why they get obsessed with the particular space that they're going after. And like, I don't want to spend a bunch of time on the macroeconomics and understand the market size and all that kind of stuff, but like, what is the problem that they're really trying to solve and why they're so passionate about it? Because what I'm really trying to assess is what I think is, who are people who are going to be founders of movements, right? If you think about every single sector out there, there's always a few faces that emerge who are the people that represent that. It's built by a community, but it's always a handful of people who are the face of that movement. And that's what I'm really looking for.
So taking that further, I mean, you've had a number of successes as an entrepreneur and investor. Let's take one of your most recent big successes, Fitbit. You were an early investor. What was it? So you're telling me it wasn't the idea; it was the team on that one.
You definitely have to square it up with the idea at some point in time, mm-hmm. right? But if you follow the smart founders and you really listen to why they get obsessed about a category or why they think it's possible, you'll become a believer, right? If they're really compelling. And that's the key. Like, you have to really spend time and just dig deeper and deeper and deeper. I think what we saw with James Park was somebody, this is circa 2007, 2008. Mm-hmm. Nobody was investing in hardware, period. We did MakerBot and Fitbit in a very short time frame. And I think what James kept saying to us is, like, you don't understand. There's so much data we can capture in a very ambient way that informs people. And it's not just a gimmick, right? It actually extends itself into healthcare, how you manage your body, right? How you think about your health, how it becomes something that's front and center to you all the time. And he just kept going deeper and deeper and deeper into why that was going to make an impact on society and why his idea was a really great idea. Mm-hmm. And so over time, we became convinced. I think we put $1 million in at a relatively modest valuation. And,
you're not going to tell us what that was?
Well, we own 25% of the company today, and it's a public company, valued at about $10 billion. So, it was a good deal.
Well.
It was we did okay.
Yeah. So how? And one of the things that founders are always surprised when I won't write a check overnight. I really like to get to know the founder and see them through different situations and circumstances. I mean, the kind of culture of the Valley right now is, or I'd say about a year ago, is that financing seemed to be going on overnight. I mean, was that really happening? And how do you reconcile, what you just, what you said with having to move quickly?
Yeah, I think almost all the time our best deals are deals that we do almost on the spot. Mm-hmm. But that doesn't mean that we had an hour meeting, mm-hmm. right? It might. I think the intensity of our meetings can be a little overwhelming to a lot of founders. We'll pull people in real quickly. We build consensus. I think speed is absolutely mission critical, and I think the beauty of our model. We manage about $1 billion now. We have 4 funds. Each fund's around roughly $250 million. But we're looking to cut checks in the $500,000 to $1.5 million kind of range. And when you look at the risk from our perspective, if we get really excited about that founder, right, to write $1 million check and to do it fairly quickly, it's not that big of a risk.
Mm-hmm.
You know what I mean? So yeah, we will act very quickly.
When you have a large fund, that's true. But then you also, if you're investing early, and from what I've seen of you guys, you are very active and working with the teams. So how do you do that with such a large fund?
Well, the other thing too is I think if you look at what we do at True, we like it weird. I mean, honestly, like if you look at my own portfolio, the things that I've done,
Well, you look at you.
Well,
right.
thank you. I'm pretty weird for sure. Nice. Gonna get you
I
for
know
that
you
backstage.
for a while. I could do
but,
that.
one of the first investments I did was Danger, which was the first smartphone with Andy Rubin.
Mm-hmm.
And that was an odd, it was an odd concept, right? That this phone would actually become a computer in your pocket. Stonyfield Farms, Blue Bottle Coffee most recently. MakerBot, Fitbit, these things,
mm-hmm.
they're all a little offbeat and weird. So
Mm-hmm.
I feel like, when you start to get outside of the kind of the hot spaces,
Mm-hmm.
you have a little bit more time to actually,
Yep.
to make that deal, right?
Yep.
And you can be a little bit more aggressive.
Yep.
Because not everybody's looking at it.
Yeah, and
that's the key.
That is the key, and I did that with the blockchain sector a year and a half ago, and it's working out really well. And I think you guys are certainly a model of what early stage venture should be about. It is looking further in the future than I think a lot of investors are doing these days.
Yeah. But I do want to come back. I think, you eventually you have to square up on the idea.
Yeah.
Right? So, and that's the key. So let's take Blue Bottle Coffee, because I think that's such a weird one. When we did that investment, people were going like, what are you doing?
Mm-hmm.
Like that's so off target, whatnot. But when I sat down with James Freeman, who's the founder of Blue Bottle Coffee, it was no different than sitting down with James Park, right, at Fitbit, or Bree Pettis at MakerBot, or Matt Mullenweg, who spoke to you earlier from Automatic, right? He was able to go in to a certain level of depth and
mm-hmm.
passion around why his product was different,
mm-hmm.
right? It's just coffee.
Yep.
On the surface, it's just coffee, but he started talking about sustainability, organic farming, certification for organic farmers in places where it's really expensive to do that. How
mm-hmm.
could the company do that, right? Freshness of beans, how you roast the beans. And then he went into the glassware. And this is where he had me. He's like starting to tell me like, an espresso has to be in this little porcelain cup because it's married to the temperature and the consumption of it, right? And I'm like, what is he talking about? He goes, yeah, you can't get an espresso drink to go at Blue Bottle. I'm like, really? He's like, yeah, that's just horrible. We're not going to deliver you happiness. And I'm like, well, okay, so why does this matter to the world? He's like, everybody drinks coffee. It's one of the first things they do in the morning, right? Why shouldn't it be delicious? Why shouldn't it be thought out? Why shouldn't
mm-hmm.
we eliminate decision making in the line? No small, medium, large. No flavorings.
The anti-Starbucks.
There you go, right? Yeah. Simplicity, right? And it's balancing that quirkiness and that obsession with simplicity. And I think
mm-hmm.
when you find that founder who's doing that,
mm-hmm.
wow.
Yeah.
That's one where you pay attention. You say, you know what? I'm going to back up the truck and I'm going to back that person because they see it and they're going to carry everybody with them.
Yep. Yeah, and that's an excellent point where the founder needs to be able to attract people to his or her vision, right? And no one can do it alone. So that is also an important part of finding the right founders. And it's that kind of glint in their eye, that passion that they show. And you can always tell the difference between the people who are just being opportunistic versus the people who are truly passionate about what they're building.
That's right.
Yeah. Okay, so you showed me a text before we went on about one that you did miss.
I missed a lot.
Well, one specifically that I also think is just a fantastic company that's being built right now, and that's Snapchat.
Yeah.
So what was it that made you not take a look at it when you were shown the company, or did you meet with them and decided not to invest?
Well,
what happened there?
I think that one is that one's a hard one to live with because I didn't actually meet with the company,
mm-hmm.
right? So we didn't actually make time. So as she's referring, I was just laughing in the backstage about Nick Bilton, who is a columnist at the New York Times and wrote about the tech section. Last night at dinner, when we were all having dinner, he wrote me, he said, so I wrote the first ever story about Snapchat and noticed that right after I'd written the story in May of 2012, I forwarded you a link to the article and made an introduction to Evan. And said you should take a look at this company immediately. Guess what? You never replied. Lots of laughs. Thanks for dinner. They got that popped up. Yeah, it happens, right? I mean, I'm both a founder of About.B, and so I have an operating role, and I'm also part of the founding team at True Ventures and a partner and active in a lot of deals. So my life can get a little crazy, and sometimes I just don't. I don't follow up in the way that I should. But the ones that are easier to live with are the ones where you've just made a call. You know, I missed on Pinterest.
Did you meet with them?
I met, yeah, absolutely.
Okay.
You know, and I remember I came back and said, this is a special founder.
Mm-hmm.
I actually did say that in our partner meeting. I said, I think we should cut like a small little check. But, you know, whatever. I just, you know, I didn't think that people would drag things up into their browser. You know, that little that bookmarklet.
Because you're not in their target market.
And then the next thing I heard about it was from my sister who lives in the middle of nowhere. She's like, have you heard of Pinterest? I'm like, yeah, thanks. Appreciate that. Sometimes you lose. I lost on Instagram. You know,
Right.
Kevin worked for me at Sphere, my first company, and showed it to me. And we got caught up in, we couldn't get a big enough piece of ownership. And so we passed, right? We're very ownership-centric. I think one of the things that's really important for you if you're a founder out here is I always tell you is like you don't spend enough time understanding what that investor's needs are across the table. And I think you need to spend as much time analyzing that as you should be pitching, right? You should really understand like what do they need so you have alignment. And so sometimes you're going to miss, but we held our ground on Fitbit just to run the economics for you, right? So we could have had maybe 10% of Instagram, and that would have been worth about $100 million. And, you know, we held here, and this is worth over $2 billion, right? So holding to that, you know, and James had a lot of demand. And that could have we could have shaved off half of our investment there
so
if we not held.
at the early stage when you invested, it was a competitive
deal. So I think
deal.
if you look at the numbers, while we missed on one, we held our ground and we got lucky and we hit. There's an order of magnitude difference in the return in these equations.
Yeah, just these slight ownership percentage differences at the early stage make a difference. I mean, with a smaller fund, I'm a lot less ownership driven, but if you run the numbers, it certainly makes a difference.
Yeah, I'm lucky that, you know, two of the two founding partners, John Callahan and Phil Black, are just maniacal about that, right? Like, we really have to get to 15 to 20% ownership. Right. Otherwise, we're not in alignment with that founder. Yeah.
Yeah, and I have to echo what Tony just said in terms of researching the investors, and I'm more likely to take a call or look at something if the entrepreneur has targeted it towards me, and I view that as, you know, that's what they should be doing with their customers and their product, and know why I would be a good investor for them, because not all investors are created equal. Investors invest in different things. I mean, you said you like weird things. They should know that they should go to you for weird things.
Yeah, please. Bring all your weirdness, people. I'm ready. We got that.
One more question. We're almost out of time, but the Valley, I want to get there quickly because I'm based in New York. I've spent a lot of time in the Valley. What's your view on the future of the Valley?
Well, you know, I used to have a bit of a contrarian view that I thought I thought you didn't need to be in the Valley, and I've come full circle back to that point of view. But I tell you what's changed, though. I went through a period where I thought, no, you absolutely should be in the Valley because it has inherent, you know, advantages, right? Unfair advantages for you as a founder, an entrepreneur. I think that now exists in so many different regions of the world, but it's not as many as you might think, right? In the U.S., I really put it in probably 3 regions: New York, San Francisco, and possibly Seattle still. But you know, in China, obviously, is amazing.
Yep, and that's why we're all here.
Hey, listen, thank you, everyone.
Thank you,
right.
and thanks, Tony.
Thank you, Jalak.